Imagine spending 30 years building wealth, buying investments, saving every month, watching your portfolio slowly grow. Then one morning, nothing about your investments changes. Nothing about the market changes. But a politician changes one number. And suddenly tens of thousands of dollars belong to the government instead of you. That sounds impossible. Yet in recent years, countries around the world have shown just how quickly tax rules can change. Canada became one of the clearest examples. But this isn't really a Canadian story. It's a lesson for every investor living in the United States, the United Kingdom, Australia, Switzerland, or anywhere else. Because governments don't need your investments to lose value. They only need to change the rules. And today we're looking at the tax rule that quietly decides how much of your investment profits you actually get to keep. Every investor asks one simple question. When I eventually sell, how much will I keep? Most people spend decades trying to increase their returns. Very few spend time understanding how taxes determine those returns. Because your investment doesn't have to perform badly for you to lose money. Sometimes the tax system changes instead. And one small percentage can completely reshape your financial future. Then begin. In 2024, Canada became a fascinating case study. Now continue explaining everything exactly as your transcript explains. Instead of making the whole video about Canada. Present Canada as a real-world example. Canada proposed increasing the taxable portion of capital gains. The proposal created uncertainty across the country. Business owners accelerated sales. Families rushed difficult financial decisions. Professional investors reorganized portfolios. Months later, the proposal was cancelled before becoming law. The tax increase never arrived. But the message had already been delivered. Governments can change the economics of investing far faster than most people realize. Around the world, capital gains taxes already look very different. In the United States, rates depend on income and how long you've owned the investment. In the United Kingdom, annual exemptions have been reduced dramatically over the past few years. Australia taxes capital gains differently depending on how long assets are held. Switzerland is one of the few countries where many private investors currently pay no capital gains tax on privately held securities. Yet other forms of wealth and investment taxation still exist depending on circumstances and location. Different countries. Different rules. One common reality. Tax policy changes. And investors who ignore those changes often discover them too late. This story isn't really about Canada. It's about something much bigger. Every government needs revenue. When public spending rises, tax policy often changes with it. Sometimes income taxes. Sometimes property taxes. Sometimes investment taxes. The numbers may differ. But the principle never does. The more wealth you build, the more important tax efficiency becomes. Instead of TFSA, RSP only. Say. The exact accounts differ depending on where you live. Then explain. In America, investors often use Roth IRAs and 401(k)s. In Britain, many rely on ISAs and pension accounts. Australians use superannuation. Swiss investors often benefit from pension pillars and tax-efficient investing. Different names. Same purpose. Keeping more of what you earn. The biggest investment risk isn't always a market crash. Sometimes it's a policy change. A single sentence in a government budget can change the value of decades of planning. Markets rise. Markets fall. Governments change. Tax laws evolve. The investors who build lasting wealth aren't simply the ones who earn the highest returns. They're the ones who understand the rules before those rules change. Because in the end, building wealth is only half the journey. Keeping it is the other half. If you enjoyed this video, don't forget to like, subscribe, and turn on notifications. See you in the next one.